Welcome we're in Da Dumalang Molo Sarobona Hukandat, and a warm welcome to the Indufo Knowledge Cast, the podcast where your curiosity meets insightful conversations. Today, we're diving deep into the world of IFRS 10. That's International Financial Reporting Standards, specifically IFRS 10. You know when a South African business starts making it big, expanding, maybe buying up other companies, things can get a little complicated, like trying to find parking in Sanditon on a Friday afternoon.
That's a great analogy, and that's where IFRS 10 comes in. It's all about bringing clarity to these complex financial situations, helping companies present a true and fair view of their financial position, even when they have fingers in many pies.
So it's like making sure everyone's borrower's role is properly accounted for at a BRI, even if you've got different people bringing different ingredients.
Exactly. IFRS 10 aims to create a standardized recipe for financial reporting, ensuring consistency and transparency, no matter how many companies are in the potchi, so to speak.
We've got excerpts from the actual IFRS 10 document right here, so we're going straight to the source. But before we get into the nitty-gritty, let's take a quick trip down memory lane. IFRS 10 hasn't always been around, has it?
You're right. It's had quite a journey. It actually started its life back in 1989 as IAS 27. And it's gone through a number of revisions and amendments over the years.
I guess the business world doesn't exactly stand still, does it?
Yeah.
Things change, companies evolve, new challenges pop up faster than potholes on a Joburg road.
You hit the nail on the head. Each change to IFRS 10 reflects those evolving challenges. Take the introduction of IFRS 12 in 2011, which focuses on disclosing interests in other entities. That's all about lifting the veil and showing the connections between companies, even when they're not a majority shareholder.
So no more hiding the secret ingredient in the financial pachicos.
Transparency is key. Then in 2012, we saw the introduction of the concept of investment entities, which get special treatment under IFRS 10.
Okay, investment entities. This is where it starts to get interesting for me. Can we unpack that a bit?
Sure. Imagine a company that's basically a professional investor, like a Stockville, but on a massive scale. They pool money from investors, and their sole purpose is to invest that money for returns, either through capital appreciation or investment income.
So instead of buying groceries or paying for school fees, they're buying chunks of other companies.
Exactly. And because their business model is so unique, IFRS 10 has specific guidelines for how they should account for their investments. But that's a topic for a later segment.
Fair enough. But before we jump ahead, I want to go back to something you mentioned earlier, control. It seems like that's a pretty central concept in IFRS 10.
Absolutely. Control is at the heart of it all. You see, IFRS 10 isn't just about who owns the most shares in a company. It's about who has the power to direct the activities that really matter, the ones that determine a company's profits or losses.
So it's like having the braipongs and deciding what gets cooked, even if you didn't bring all the meat.
That's a good way to put it. And IFRS 10 gets very specific about how to determine control. It boils down to three key elements: power over the investee, exposure to variable returns, and the ability to use your power to affect those returns.
Okay, break that down for me. What do you mean by power over the investee?
Think of it as having the ability to call the shots, to make the big decisions that affect the investee's activities. This could be through voting rights, contractual arrangements, or even just having the right people in key positions.
And exposure to variable returns. That sounds a bit like gambling.
Not quite. It just means that your potential profits or losses are directly linked to the investee's performance. If they do well, you stand to gain. And if they struggle, you could lose out.
Okay, so you've got to have some skin in the game. What about the last element, being able to use your power to affect those returns?
This is where it all comes together. You can have power and you can be exposed to the ups and downs. But if you can't actually use your power to influence the outcome, then you don't really have control.
It's like having the braitongs, but not knowing how to make a decent fire. All the potential, but no sizzle.
Exactly. And that's why IFRS 10 provides guidance on how to assess these three elements in different situations. Because believe me, it's not always as straightforward as it seems.
I bet. So let's dive into some of those complex scenarios, those real-world situations where figuring out who's in control can get a little tricky.
All right, let's take a look at a few examples straight from the IFRS 10 document. They'll help illustrate just how nuanced this concept of control can be. For instance, example 1 talks about two investors who are developing and marketing a new medical product. One investor is handling the research and development, getting all the necessary approvals, while the other is responsible for manufacturing and marketing once the product is ready to go.
Sounds like a classic partnership, each bringing their own strengths to the table. But who gets to hold the braitongs in this situation?
That's the million-rand question. To figure it out, we need to analyze which activities have the most significant impact on the company's returns. Is it the initial development phase with all its uncertainties and regulatory hurdles? Or is it the actual production and sales once the product hits the market?
I can see how that could be a tough call. What are some of the factors they'd consider?
Well, they'd look at the purpose and design of the company, the things that drive its profits and overall value. They'd also assess how each investor's decisions contribute to those factors. For example, if the success of the product hinges on securing a patent or navigating complex regulatory approvals, then the investor leading the R&D might have a stronger claim to control.
So it's not just about who's doing the most work, it's about who's making the decisions that really matter.
Exactly. And let's not forget about the risks involved. In this example, they'd consider things like the uncertainty of getting regulatory approval, the effort required in the development phase, and who ultimately controls the product once it's launched. All those factors contribute to determining who holds the reins, so to speak.
This is getting juicy.
Yeah.
Okay, what about another example? Something a bit different.
All right, let's jump to example 2, which takes us into the world of investment vehicles. Imagine a group of people pooling their money to buy a portfolio of assets. Let's say bonds.
Okay, so they're spreading their risk by investing in a bunch of bonds.
You got it. Now, one of these investors, who holds a decent chunk of the equity, is also the asset manager. They call the shots on which bonds to buy and sell, how to manage the portfolio within certain guidelines set by the group.
So they're like the conductor of the bond orchestra.
A perfect analogy. But here's the twist. There's also a debt investor involved, someone who lent money to this investment vehicle. And there's a clause in the agreement that says if the value of the bonds drops below a certain level, the debt investor gets to step in and make the decisions.
So control can shift depending on how the investment is performing. It's like a game of financial musical chairs.
Precisely. And that's why assessing control requires a careful analysis of all the agreements, the power dynamics, and the potential triggers that could shift control from one party to another.
These examples really highlight how nuanced and context-specific control can be. It's not always about having the most shares or being the loudest voice in the room.
Absolutely. It's about understanding the substance of the arrangements. Who really has the power to direct the activities that matter most?
Okay, so we've established that control is the key ingredient in IFRS 10. But once you've figured out who's in control, what happens next? What's the practical implication of all this?
Well, once control is established, that triggers a whole set of accounting rules about how to present the financial information for that group of companies. It's like figuring out how to combine all the ingredients in your pachiekos to create a single delicious dish.
So we're talking about consolidated financial statements.
You got it. Consolidated financial statements bring together the financial information of the parent company and all its subsidiaries, those companies it controls, into one unified report. It's like creating a panoramic view of the entire financial landscape.
Sounds impressive. But I imagine combining all those financial pieces can get a bit messy. How does IFRS 10 ensure consistency and accuracy in this process?
IFRS 10 provides a structured approach to consolidation, outlining specific steps and principles to ensure the consolidated statements provide a true and fair view of the group's financial position. It's like having a recipe that ensures your pochecos is cooked to perfection every time.
Okay, walk me through those steps. What's the recipe for creating a consolidated financial statement?
Well, the first step is combining like items. You're bringing together all the assets, liabilities, income, expenses, and cash flows from each company. It's like gathering all the ingredients for your pochecos, the meat, the veggies, the spices, and laying them out on the table.
So it's about aligning all the financial pieces of the puzzle.
Exactly. Then comes the elimination of the parent company's investment in each subsidiary and its portion of the subsidiary's equity. This prevents double counting and ensures you're only reflecting the group's overall financial position. Think of it like removing the packaging from your ingredients before you add them to the pot. You want the pure essence, not the extra fluff.
Makes sense.
What else? Next comes the elimination of any transactions that occurred between the companies within the group. Remember, we're trying to present the financial picture as if it were one big happy family, so any internal dealings need to be accounted for. It's like making sure that if one family member lends money to another, you don't count that as both an expense and income for the family as a whole.
So no sneaky transfers or favors flying under the radar.
Transparency is key. And lastly, everyone has to play by the same rules. The consolidated statements must use uniform accounting policies. It's like making sure everyone is using the same measuring cups and spoons when adding ingredients to the pachecos. Consistency is crucial for a balanced flavor.
Okay, so consolidated statements bring order to the financial chaos. But what about those who have a stake in the company but aren't calling the shots? What about the non-controlling interests?
Ah, an excellent point. IFRS 10 has specific guidance on how to handle those two. Think of it like recognizing the contributions of those family members who maybe don't have a say in the big decisions, but still own a piece of the pie.
So they get a slice of the financial pachicos, even if they aren't the ones stirring it.
Exactly. Their interests are represented within the equity section of the Consolidated Statement of Financial Position. But separately from the equity of the parent company's owners, it's about giving credit where credit is due, even if they don't have the same level of control.
So everyone gets their due recognition. Now, what happens when a parent company decides to sell off a part of its business empire? Does IFRS 10 cover that too?
You bet. IFRS 10 guides us on what to do when a parent company loses control of a subsidiary, whether through a sale, a merger, or other circumstances. It's like taking a portion of your perfectly cooked pochacos and sharing it with a neighbor.
Okay, here's where it gets really interesting. Walk us through the process. What are the key steps involved?
Well, the first order of business is to derecognize the assets and liabilities of the subsidiary from the consolidated statements. It's like removing a portion of the stew from the pot.
Makes sense. Out with the old. What about the new?
Next, you need to recognize any investment that's been retained in the former subsidiary. This could be because the parent company didn't sell off its entire stake. Or perhaps they've acquired a new type of interest in the company. It's like keeping a little bit of the stew for yourself, even after you've shared some with your neighbor.
So it's about updating the financial picture to reflect the new reality.
Precisely. And this retained interest gets remeasured to its fair value at the date control is lost. It's like checking the market price of that smaller portion of stew you kept.
And lastly,
Last but not least, you need to recognize any gain or loss associated with losing control of that subsidiary. This involves calculating the difference between the carrying amount of the investment and the fair value of the consideration received. It's like figuring out if you made a profit or took a loss on that portion of stew you shared.
wow, who knew losing control could be so complex? But I imagine these rules help ensure transparency and accountability when companies are restructuring or selling off assets.
Absolutely. It provides a clear framework for reflecting these changes in the financial statements, ensuring everyone has an accurate picture of what's happening.
Okay, so we've covered a lot of ground already. From the history of IFRS 10 to the concept of control and the ins and outs of consolidation. But remember earlier we touched on this intriguing topic of investment entities.
Ah, yes. Those companies whose sole purpose is to invest in other companies, they play a unique role in the financial ecosystem. And IFRS 10 treats them a little differently.
So they get their own special set of rules. What makes them so unique?
Well, IFRS 10 defines an investment entity as one that meets three key criteria. Firstly, they obtain funds from investors specifically to provide investment management services. It's like being a professional Pachico chef. But instead of cooking, you're managing investments.
So they're the financial masterminds who know how to combine the right ingredients for maximum flavor. Or, in this case, returns.
Exactly. Secondly, they commit to investing those funds solely for returns from capital appreciation or investment income. Their focus is laser sharp on growing that money. It's like putting all your energy into making the most delicious pachecos possible. Nothing else.
No side dishes, just pure investment goodness. What's the third criterion?
Thirdly, they measure and evaluate the performance of almost all their investments based on fair value. It's like constantly checking the market price of your ingredients to make sure you're getting the best value for your money.
This is painting a pretty clear picture of what sets investment entities apart. But I'm curious about those situations where they might only have a single investment or a single investor. Does that automatically disqualify them from being an investment entity?
Not necessarily. IFRS 10 recognizes that there can be valid reasons for these temporary situations. For instance, a new investment entity might be in its startup phase, still scouting for the perfect investment opportunities, or they may have recently sold off an investment and are in the process of finding a replacement. It's like waiting for the perfect piece of meat to sizzle on the braai. Sometimes patience is key.
Makes sense. So it's about understanding the context and the long-term strategy of the entity, rather than making snap judgments based on a snapshot in time.
Absolutely. And the same logic applies to having a single investor. It could be that they're in the midst of a fundraising round, or perhaps they were established to manage a large pool of funds for a single significant investor, like a pension fund.
This is reminding me of something we touched on earlier, the importance of fair value measurement for investment entities. Can you remind us why that's so crucial?
Sure thing. Remember, the core business of an investment entity is managing investments to generate returns. So it makes sense that their financial reporting should reflect the current market value of those investments. Fair value provides a more relevant and up-to-date picture compared to, say, the historical cost of the investments.
It's like checking the price of Miley's at the market today, rather than relying on what you paid for them last year.
Exactly. And IFR 10 emphasizes that investment entities should not only use fair value in their financial statements, but also internally when making investment decisions. It's all about staying agile and responsive to market fluctuations, like a true financial chameleon.
Okay, so we've covered the defining features of investment entities and their love for fair value. But let's not forget that they still have to deal with the nitty-gritty of accounting. Are there any specific challenges or considerations they face when it comes to crunching the numbers?
You're right, even financial wizards have to grapple with the practicalities of accounting. And IFRS 10 provides some guidance on how to handle these unique situations. One key area is determining the appropriate accounting treatment for investments in other investment entities.
Investment entities investing in other investment entities. Now, that's a mouthful.
Imagine it like a group of stockfuls coming together to form a super stockful. It can get quite complex.
So how do they untangle this financial knot?
Well, IFRS 10 says that an investment entity should generally measure its investment in another investment entity at fair value through profit or loss. This aligns with their core business model and ensures transparency in their financial reporting.
So even though they might have significant influence or even control over another investment entity, they're still primarily focused on the fair value of that investment.
Precisely. It's about cutting through the layers of complexity and presenting a clear picture of the investment entity's overall financial position.
This is making me realize that navigating the world of investment entities requires a special kind of financial savvy.
You're telling me. But thankfully, IFRS 10 provides a roadmap to help us understand their unique characteristics, accounting practices, and the exceptions that apply to them.
It's like having a trusted guide in the sometimes confusing world of high finance.
Exactly. And as we've seen, even though investment entities might seem like they operate in a different dimension, the principles of transparency, accountability, and accurate financial reporting still apply.
And with IFRS 10 as our trusty companion, we can confidently navigate this complex terrain.
Indeed. IFRS 10 provides a robust framework for ensuring that investors, regulators, and the public have a clear and accurate understanding of the financial health of investment entities.
Well, folks, it seems we've reached the end of another insightful segment here on the Indubo Knowledge Cast. But don't switch those dials just yet. We've got one more leg of our IFRS 10 journey ahead of us.
In our final segment, we'll put all the pieces together and explore some real-world examples of how these standards are applied in practice. It's like adding that final sprinkle of spice to our financial pochicos to bring out all the flavors.
Stay tuned for more financial wisdom, served with a side of South African flair, of course.
Welcome back to the Indubo Knowledge Cast. Before we got sidetracked by those delicious braai analogies, we were about to delve into some real-world examples of how control is determined under IFRS 10.
Yes. Let's get into the meat of it. I'm all ears.
All right, so example 1 in the IFRS 10 document talks about two investors who are teaming up to develop and market a new medical product. One investor is handling the research and development, getting all the necessary approvals, while the other is responsible for manufacturing and marketing once the product is ready to go.
Sounds like a classic partnership, each bringing their own strengths to the table. But who gets to hold the braai tongs in this situation?
That's the million-rand question. To figure it out, we need to analyze which activities have the most significant impact on the company's returns. Is it the initial development phase, with all its uncertainties and regulatory hurdles? Or is it the actual production and sales once the product hits the market?
I can see how that could be a tough call. What are some of the factors they'd consider?
Well, they'd look at the purpose and design of the company, the things that drive its profits and overall value. They'd also assess how each investor's decisions contribute to those factors. For example, if the success of the product hinges on securing a patent or navigating complex regulatory approvals, then the investor leading the R&D might have a stronger claim to control.
So it's not just about who's doing the most work. It's about who's making the decisions that really matter.
Exactly. And let's not forget about the risks involved. In this example, they'd consider things like the uncertainty of getting regulatory approval, the effort required in the development phase, and who ultimately controls the product once it's launched. All those factors contribute to determining who holds the reins, so to speak.
It's getting juicy. Okay, what about another example? Something a bit different.
All right, let's jump to example 2, which takes us into the world of investment vehicles. Imagine a group of people pooling their money to buy a portfolio of assets, let's say bonds.
Okay, so they're spreading their risk by investing in a bunch of bonds.
You got it. Now, one of these investors, who holds a decent chunk of the equity, is also the asset manager. They call the shots on which bonds to buy and sell, how to manage the portfolio within certain guidelines set by the group.
So they're like the conductor of the bond orchestra.
A perfect analogy. But here's the twist. There's also a debt investor involved, someone who lent money to this investment vehicle. And there's a clause in the agreement that says if the value of the bonds drops below a certain level, the debt investor gets to step in and make the decisions.
So control can shift depending on how the investment is performing. It's like a game of financial musical chairs.
Precisely. And that's why assessing control requires a careful analysis of all the agreements, the power dynamics, and the potential triggers that could shift control from one party to another.
These examples really highlight how nuanced and context-specific control can be. It's not always about having the most shares or being the loudest voice in the room.
Absolutely. It's about understanding the substance of the arrangements. Who really has the power to direct the activities that matter most?
Okay, so we've established that control is the key ingredient in IFRS 10. But once you've figured out who's in control, what happens next? What's the practical implication of all this?
Well, once control is established, that triggers a whole set of accounting rules about how to present the financial information. For that group of companies, it's like figuring out how to combine all the ingredients in your pochicos to create a single delicious dish.
So we're talking about consolidated financial statements.
You got it. Consolidated financial statements bring together the financial information of the parent company and all its subsidiaries, those companies it controls,
Right.
into one unified report. It's like creating a panoramic view of the entire financial landscape.
Sounds impressive. But I imagine combining all those financial pieces can get a bit messy. How does IFRS 10 ensure consistency and accuracy in this process?
IFRS 10 provides a structured approach to consolidation, outlining specific steps and principles to ensure the consolidated statements provide a true and fair view of the group's financial position. It's like having a recipe that ensures your pochicos is cooked to perfection every time.
Okay, walk me through those steps. What's the recipe for creating a consolidated financial statement?
Well, the first step is combining items. You're bringing together all the assets, liabilities, income expenses, and cash flows from each company. It's like gathering all the ingredients for your pochicos, the meat, the veggies, the spices, and laying them out on the table.
Welcome back to the Indubo Knowledge Cast. We've explored the ins and outs of IFRS 10, from its history to the nitty-gritty of control and consolidation.
And we even delved into the world of investment entities. Those financial chameleons with a knack for sniffing out returns.
But before we wrap up our deep dive, I'm keen to see how all this theory plays out in the real world. Less textbook, more taxi rank.
I hear you. Let's bring IFRS 10 to life with some practical examples. Remember those multi-seller conduits we touched upon earlier? Example 16 in the IFRS 10 document.
Yes. The one where a sponsor sets up a conduit to issue short-term debt, backed by a portfolio of medium-term assets. It's like a financial relay race, with money changing hands at lightning speed.
That's a great way to put it. This example highlights how tricky it can be to assess control, especially when you have multiple parties involved.
So it's not just about who owns the most shares, but who has the real power to steer the ship.
Exactly. The sponsor might not own a majority of the equity in the conduit, but they often have significant influence over key decisions. They get to approve which sellers can participate, what assets are included in the portfolio, and even how the conduit is funded. They're like the conductor of a financial orchestra, making sure everyone hits the right notes.
But they're not just calling the shots, are they? They're also taking on some serious risks.
Absolutely. They typically provide credit enhancement and liquidity facilities, meaning they're on the hook if things go south. And don't forget, they're also entitled to any residual returns. The profits left over after all the other investors have been paid.
So they're sharing in the potential rewards
Yeah.
and the risks. That sounds like a pretty good indicator of control to me.
Exactly. And in this scenario, IFRS 10 would likely conclude that the sponsor, despite not having majority ownership, actually controls the conduit. It's a classic example of substance over form.
This really brings home the point that control is a multifaceted beast. What about another real-world scenario, something that highlights those special consolidation exceptions for investment entities?
All right, let's imagine an investment entity that specializes in real estate. They've got a portfolio of properties across South Africa, from those shiny office blocks in Sandton to charming guest houses in the Cape.
It's like a dream job, managing all those properties.
Now, let's say they set up a subsidiary company, specifically to handle the day-to-day management of these properties. This subsidiary takes care of everything, from collecting rent to arranging maintenance and finding new tenants.
Ah, so they've created an in-house team to keep those properties running smoothly.
Exactly. Now, even though the investment entity owns 100% of this subsidiary, IFRS 10 might say, hold on a minute, this subsidiary isn't just a passive investment, it's providing essential services directly linked to the investment entity's core business.
So this subsidiary is like the engine that keeps the real estate investment machine humming along.
Precisely. And because of that close connection, IFRS 10 would likely require the investment entity to consolidate the subsidiary, even though it generally benefits from the exception.
These examples really showcase the flexibility and nuance of IFRS 10. It's not a one-size-fits-all approach. It adapts to the specific circumstances of each company and its investments.
Absolutely. IFRS 10 provides a framework for making informed judgments about control and consolidation, ensuring that financial reporting reflects the economic reality of complex business structures.
We've journeyed from the history of IFRS 10 to its application in real-world scenarios. But as with any good journey, it's time to reflect on what we've learned.
What are your key takeaways from our deep dive today? What nuggets of wisdom will you be carrying with you?
Well, for me, it's the realization that control isn't always about holding the majority of the voting rights. It's about having the power to influence decisions that impact a company's fortunes. And that power can manifest in various ways, through contractual agreements, strategic relationships, or even the provision of essential services.
That's a brilliant insight. IFRS 10 encourages us to look beyond the surface and analyze the intricate web of relationships and power dynamics. Within a group of companies, it's like figuring out who's really holding the brytongs, even if they're not the one standing closest to the fire.
And let's not forget the importance of transparency and consistency in financial reporting, whether we're talking about consolidated financial statements, accounting for non-controlling interests, or the special considerations for investment entities. IFRS 10 strives to ensure everyone is playing by the same rules, and the financial picture is clear and accurate.
Transparency is the cornerstone of trust. And speaking of trust, IFRS 10 plays a vital role in fostering confidence in the global financial system.
By providing a common language and a set of internationally recognized standards, IFRS 10 facilitates cross-border investment, enhances comparability between companies, and promotes a level playing field for businesses of all sizes.
And remember, as the business world continues to evolve, so too will IFRS 10. It's a living, breathing framework, constantly adapting to new challenges and complexities.
So still curious, keep those accounting skills sharp. And remember, the next time you hear about a big merger or acquisition, there's a whole world of IFRS 10 calculations happening behind the scenes, making sure the financial pachi is simmering just right.
Until next time, sharp, sharp. Stay curious and keep those knowledge fires burning.